Hi everybody. Welcome back to another Q&A session with economics questions. So my name is Jeffrey. I'll be going over some commonly asked micro and macro questions, and then going over the answers and the answer of a previous tutor to see whether or not the previous tutor has gotten it correct. With that being said, we can just jump right into the first question. So the first question says, investment levels depend mainly on A, high levels of consumption in the economy, B, the rate of return on capital, C, tax incentives, or D, strong government demand. And so, sorry about that. So going over this, investment, what does investment refer to? It simply refers to when consumers or businesses are allocating money that will be used to invest in something that will create returns in future periods of time, right? So not the current period of time, but in future periods. So you're putting in a certain amount of money now and you're hoping to get more money out of it later. And so which one of these kind of options has the most to do with this idea of investments? So A says high levels of consumption in the economy. And so this is slightly referred to investments. The more people are consuming, which means they're spending on things in the current period, the less they can spend on investment in future periods. But it's not going to be one of the main factors. There's going to be another option here that's probably a little bit better. We can move to option B, which is the rate of return on capital. And this is going to be a much better indicator of investment levels, purely because it tells us how much more we can expect to get back from our investments in the current period when we wait until a future period. And so if we have a high rate of return on capital, we're going to have higher investment levels because people are more likely to set aside their resources now and invest their capital now in order to earn that high rate of return later. On the flip side, if there's a low rate of return on capital, then people are going to be less likely to put aside money and invest it now because they don't expect to make that much more from that money in the future. So the rate of return on capital is going to be one of those very key indicators for investment levels. C says tax incentives. Yes, this is something that will affect investment levels a little bit. If you have greater tax incentives, then investments will probably have a higher rate of return. But at the end of the day, the rate of return is the most important thing. So C is not going to hit the nail on the head. And finally, D, strong government demand. And again, that's going to be slightly maybe related to investment levels, but not as much as the rate of return on capital. So B is going to be the best answer here. Let's take a look at the previous tutor's answer. So the previous tutor said that the investment is defined as the expenditure made on the capital goods for the production of the goods and services in the economy. The main determinant of investment is the rate of return on capital and is the expected benefit from the investments. If the rate of return on capital is high, the investment levels will be high and vice versa. The rate of return showing how effectively the company is turning the capital into profits. So the answer is B, the rate of return on capital. And that seems really good to me. Nothing that's really missing from the definition, so we're going to say good job and mark that as correct. Okay, next question.